Good morning, everyone. Today we're looking at the monetary policy. What we'll learn in this what monetary policy is, the tools of monetary policy, the objective of monetary policy, how the central bank counteract aggregate demand. Last but not the least, transmission channel of monetary policy. What is monetary policy? Monetary policy is a macroeconomic policy laid down by the central bank of a country. The policy involves an operation framework that uses certain instruments and targeting mechanisms to achieve macroeconomic objectives such as price stability, full employment, economic growth, low inflation, and reviving consumption. Tools central bank uses to influence money supply and credit condition. One such tool is the interest rate adjustment. The central bank sets a key interest rate that influences other interests in the economy. So a change in the base rate at which the central bank lends money to the commercial banks and other financial institutions causes changes in other rates and have a big impact on an economy. The other tool that central bank uses to influence money supply and credit condition is open market operation. With this tool, the central bank buys or sells government securities to inject or withdraw liquidity from the banking system. To increase money supply, Fed or the central bank buys government bonds with new dollars which are deposited in banks and thereby increasing reserves which bank uses to make loans, causing money supply to expand. To reduce money supply, Fed or the central bank sells government bonds, taking dollars out of circulation, and the process works in reverse. Last but not the least is a reserve requirement. With this tool, the central bank may require banks to hold certain percentage of their deposit with the central bank. This measure limits banks' ability to lend to its customers. Objective of monetary policy. The primary objective of monetary policy is to maintain price stability while keeping in mind the objective of inflation and growth. Policymakers and economists favor this policy because fluctuation in price bring uncertainty in an economy. Besides this, price stability is a necessary precondition to sustainable growth. Economic growth is one of the most important objectives of monetary policy. Central bank, by keeping the prices steady and maintaining overall financial stability, has the ability to promote economic growth. Full employment is another important objective that monetary policy seeks to achieve. Full employment is a situation in an economy in which workers who are able and willing to work can obtain the jobs and hours they want. Full employment is also defined as the lowest unemployment rate that is consistent with stable inflation. In practice, this means that the central bank can allow temporary deviation of inflation from the target level in order to achieve other objectives such as stability of the real economy and the financial sector, as long as the average level of inflation is kept on the desired level. Last but not least, the objective of monetary policy is financial stability. Financial stability means the effective functioning of financial system and the absence of banking, balance of payments, currency exchange rate crisis. By mitigating the consequences of financial instability for the economy, the central bank helps alleviate liquidity pressures and boost public confidence. How does the central bank counteract to aggregate demand shock? In order to counteract the aggregate demand shock, the central bank implements a contraction monetary policy which includes raising interest rates and decreasing money supply. When the bank does this, it prevents inflationary pressure from building up, because by increasing interest rates at which banks borrow from the central bank, the bank makes it more expensive for business and individuals to borrow money. This discourages investment and consumption, leading to a decrease in aggregate demand. The other way the central bank can counteract aggregate demand is by reducing the amount of money available in an economy by buying government securities or increasing reserve ratios for the banks. This measure reduces the availability of funds for lending and it further dampens aggregate demand. Last but not the least is the transmission channel of monetary policy. The transmission mechanism of monetary policy is a process through which monetary policy actions affect economic activity and inflation. Saving and investment is one of the channels used in monetary policy. Monetary policy influences economic activity by changing the incentives for saving and investment. For example, lower interest rates on bank deposit reduce incentives on households have to save their money. Instead, there's an increased incentive for households to spend their money on goods and services. Cash flow channel. The monetary policy influences interest rates, which affect decisions of households and businesses by changing the amount of cash they have available to spend on goods and services. This is an important channel for those that are liquidity constrained. For For example, those who have already borrowed up to a maximum, the banks will provide. A reduction in lending rates reduces interest rates repayments on dates, increasing the amount of cash available for households and businesses spend on goods and services. Last but not the least is expectation channel. The expectations channel, inflation also matter for the transmission of monetary policy. For example, if workers expect inflation to increase, they might ask for higher wage increase to keep up with changes in inflation. Higher wage growth contributes to higher inflation. By having an inflation target, the central bank can anchor inflation expectation. This should increase the confidence of households and businesses in making decisions about saving and investment because uncertainty about the economy is reduced.